Hello investors, welcome back. Today we'll discuss bad boy carve-outs. Your mortgage documents say non-recourse in black and white. End of story? Hardly. There are many circumstances under which your non-recourse loan may have recourse consequences. First, recourse means that in the event of default, the lender has the right to pursue your personal assets, including your home, your automobile, and other valuables such as jewelry. The conditions or covenants under which the lender may have personal recourse are known colloquially as bad boy carve-outs. Disclaimer: I'm not a lawyer, nor do I play one on TV. You are watching YouTube, not TV. If you're confused by that, you're probably watching too much YouTube. This video is provided for informational purposes only. Consult a legal professional in all commercial real estate transactions and do your own due diligence. Now, back to our regularly scheduled programming. Historically, most of the conditions that would trigger recourse involve fraud or mismanagement on the part of the borrower. Hence the name bad boy carve-outs. The implication is clear. If you're a bad boy, you lose your right to protect your personal assets from seizure. By insisting on these covenants in the loan documents, the lender wants to make sure that the borrower is not able to do anything that would cause damage to the value of the collateral. Now, to avoid confusion with this kind of bad boy carve-out, I'll try to stick to the more technical term, springing guarantees. To understand the legal term in more detail, consider that if any conditions in the springing guarantee prevail, springing recourse follows. That is to say that recourse springs forth from the presence of one or more of the conditions. Now, if you're interested in the bad boy carve-out I just flashed on the screen, take a look at the description below to learn more about water gilding. A few examples of springing guarantee clauses will suffice. If you fail to pay taxes or insurance, you're clearly impairing the collateral that you mortgaged to obtain the loan, and it's clear that the lender has a strong claim to recourse. After all, in the event of default, why would the lender want to have to foreclose on the property and then have to pay your back taxes? Furthermore, if you waste the asset, that is to say, if you allow the building to go into disrepair, you are again impairing the collateral that you mortgaged to obtain the loan. The lender may have recourse under these conditions. Additionally, any fraud or environmental liabilities are again an obvious impairment to the lender's collateral. Finally, you'd be expected to protect the collateral by forming a separate entity, usually an LLC, to run the particular asset. This has the effect of ring-fencing the asset from financial trouble that may arise in one of your other businesses, as well as from your own personal liability. While we're on the topic, make sure that you have an umbrella policy both personally as well as for your businesses. This is an additional layer of protection for your assets in the event of a lawsuit. All of the above seem very reasonable. In fact, they're positively necessary to ensure that honest buyers can obtain financing at a reasonable rate. Let's take a look at the history of the springing guarantee. Springing guarantees first appeared in non-recourse mortgage notes in the early 1990s. The courts have followed a trend of enforcement of these provisions, and this trend gained traction during the Great Recession. Although there has been some legislative pushback, the list of conditions has expanded to include many issues that are outside of the borrower's strict control. Suppose that a borrower files for bankruptcy as a result of being unable to pay the mortgage. This can trigger springing recourse. Now, some would say provisions that allow for springing recourse in the event of an involuntary bankruptcy go too far. Although the courts have upheld these provisions in multiple cases, including the following two from Michigan, there has been some legislative pushback, as we'll discuss in a moment. The first case is 51,382 Gratiot Holdings, LLC versus Chesterfield Development Company. And the second is Wells Fargo Bank, LNA, that's National Association, in case you're wondering, versus Cherryland Mall Limited Partnership. In both of these cases, the courts noted that the parties that signed the loan documents were sophisticated, and they upheld the language as written. Shortly after these two cases, both the Michigan and Ohio legislatures passed statute law that made this case law moot in these two states. This is probably a good time to mention that when you're signing loan documents, that it's state law that is operative, and that applicable state law should generally be specified within the loan documents. Some would say that this expanding concept of the springing guarantee means that non-recourse loans have essentially morphed into partial recourse. I'll leave that to the listener to decide. Most importantly, I want to impress upon you that over time, the risk, whether it lies with the borrower or more with the lender, is something that is continually a battleground, and you're going to see this risk shifting, ebbing and flowing. So now that you understand the concept of a springing guarantee, let's discuss the mirror opposite concept, the exploding guarantee. Whereas the springing guarantee is inactive until the presence of a condition causes recourse to spring forth, an exploding guarantee is in effect by default. What happens is that in the event of a loan default, if the borrower cooperates with the lender, you could say that the exploding guarantee is then diffused. As mentioned before, I'm not a lawyer. I bring this video to you solely in an informational capacity, as a reminder that as business owners, we operate in a constantly changing legal landscape, and it behooves us to understand that landscape and to consult competent legal counsel as needed. One of the best ways to stay up to date on current legal situations and the legislative advocacy that's going on in your locality is to join your local apartment association. Now, here is our publication from the Apartment Association of Michigan. I'm also a member of the Home Builders Association, as well a member of the Apartment Association of Greater Orlando. The people that you meet in these organizations, these contacts are pure gold. And the legislative advocacy that they perform on your behalf is something that is clearly impossible for us as individual apartment owners to accomplish. At this point, I would like to break and see you in video 2 of this series. Thank you, investors. See you on the flip side.